I really do think, and I think I even said it last time, is that the alts at some point we'll be able to figure out their valuations once we get clarity from the SEC, right? And so the SEC will say, okay, these are the rules. And then all of a sudden, big money will be able to start valuing these things. And so whether, the market caps on a Matic should be 5 billion or 25 billion or maybe 50 billion, we don't know yet, because again, we don't know what the real valuations are, but that will become clear. And my guess is at that point, that's where the value really starts to, and by the way, that's actually a good thing. Like investors need to understand that any sort of additional information that these coins can give us makes them the clarity and the transparency much better, which allows us, even as retail investors, to say, okay, I think I should pay here for this versus where it was before. And I think that's important for us.
Renowned investor Jim Rogers has recently voiced several concerns regarding the state of the U.S. economy during an episode of Sputnik's New Rules podcast. According to Rogers, the worst is yet to come, as historical patterns suggest that major economic downturns tend to follow regular fluctuations and corrections. He further elaborated that the excessive printing, borrowing, and spending of money may provide short-term benefits, but the long-term consequences will inevitably require payment. Rogers cautioned that inflation and debt problems are poised to worsen, ultimately resulting in significant hardships for the United States. Interestingly, these warnings align closely with Gareth Soloway's economic outlook, as he also highlights the current uptrend of risk assets as an indicator of a declining dollar. Moreover, Soloway suggests that the ongoing rate hikes are unlikely to cease anytime soon. In addition to his analysis, Soloway presents charts and price assessments for altcoins like Bitcoin and Ethereum, while also mentioning MicroStrategy's recent Bitcoin acquisition.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I was looking at the Bitcoin dominance chart, and with Matic starting to inch up, you actually have a very short, and again, this is very short term, because I think you and I both agree we're headed towards 57 to 59% dominance. But this is a little bit of a bearish pattern, and interesting to see the alts beginning to show a little sign of life. What I would be almost expecting is some sort of secondary short-term move. And again, mind you, short-term move, but a short-term pullback, maybe right around 50% before that next leg up. And this is what we would refer to, again, a sharp candle down with a little inside bar consolidation that might be telling us that. So that's another signal from a TA, just strictly short-term technical analysis, that maybe the alts are waking up. And then it brings, and again, I'll let you comment in just a minute on the dominance, but I do want to just bring up the Solana move has been really impressive. And that's another alt, right? Where Solana just in the last, really just since June, mid-June, so we're talking less than a month, or right about a month, is up 50% off of its lows, which is very, very impressive. Yeah, I think that's what's so cool about the dominance chart or any of these charts, is that generally they still abide by the technicals of what an Apple chart will do or anything. And I think that's always been the big question for people, at least when they come to me. They're like, well, you've always traded stocks. What makes this work on cryptocurrencies, or what makes it work on commodities, or what makes it work on dominance? And the beautiful thing about it is that technical analysis isn't about the specific asset. It's about the people that are trading the asset. And if you go back to I don't know if you know much about the tulip mania in the 1500s, Ben, but I mean, the same greed that drove, people literally were buying homes for one bulb of tulips, like one tulip bulb. That's how crazy it got, which again, that greed is the same greed that helped the dot-com bubble create, the housing bubble in 07 leading to 08, the crypto bubble where we saw shit coins and everything go up like crazy. It's the same thing. And so when you're charting things, as long as you have human participants, now you can get into AI and what happens then, who knows, but human participants, it should behave the same way. A week or two ago, when we heard that MicroStrategies had bought another 100,000 plus Bitcoin, and the reason why that jumped out at me is I was a little bit concerned that price didn't go up more with that big of a buyer in the market. And the question is, if it didn't go up more when they were buying that much, who was selling into them? And again, not that I'm not going to pretend that I know, but it is, kind of the same, along the same lines of, when you have good news and something doesn't go up. We had the ETF news for the spot market, and we didn't see a breakout above 31,000 yet. Now, maybe it still happens, but these are little things that I kind of just am saying, that's kind of interesting on a price action. Now, again, the bulls are going to say, hey, it's going to happen. And long term, I believe it will. But again, that's just something that I'm kind of a little bit concerned about when it comes to Bitcoin in the near term. The price action hasn't been, breaking out above this level. And just looking at the ETH chart real quick, I saw a couple questions asking about the ETH analysis. And, just from a technical standpoint, you're above this channel. So you had a little bit of a breakout of the channel, but the price action over the last week or so has not been good, where you made a higher high and then you reversed that pretty quickly, and you're making a little bit of a bearish pattern here. So based on this, the probabilities are that we probably need to retest this line right here before maybe making an attempt to rally up. Now, one of the things to look at here in terms of technicals is if you look at this trend line, look at how this trend line is ready to merge into it. One of my favorite technical plays on a chart is if price comes into two moving average. Well, you could have moving averages, you could have one moving average and a trend line, but essentially the idea is if you liked it at a moving average, or if you liked it at one trend line, if you get two trend lines together, it creates an even stronger support. So if, let's just say we pull back into this area, let's say it takes that long, this would be an even better buying opportunity on ETH for a bounce versus if it was just coming down right to here where it's just one. All right. So again, just kind of something to kind of keep in mind there.
In a recent statement, U.S. Treasury Secretary Janet Yellen defended the strong position of the U.S. dollar, citing its widespread use in global trade. Yellen emphasized that the USD's dominance is a result of factors such as the deep and liquid capital markets, adherence to the rule of law, and the availability of extensive financial instruments in the United States. However, she did acknowledge in April that the continuous utilization of financial sanctions over time could potentially undermine the hegemony of the dollar. Moreover, Yellen also remarked earlier this month that the growing trend of countries seeking to establish alternative reserve currencies to challenge the US dollar is an anticipated development. She highlighted that this shift is something that the United States must be prepared to face. Returning to the video, Soloway delves into an analysis of the US dollar chart, exploring its current trends and patterns.
So I want to pivot over. You had mentioned the US dollar here, and I think this is an important chart for us to take a look at, because I think last week I was showing you guys this chart of this wedge pattern that was being created, and just in the last 3 trading days, the dollar, look at that, it's starting to just inch below the trend line. Now, again, this, we've inched below on an intraday basis multiple times over here and touched it right here. But this is something that I would start paying attention to in terms of a potential breakdown on the dollar. And to extrapolate that out, I think that what that's telling us is that we're now starting to get jobs data that's weakening, right? So up until the non-farm payrolls on Friday, we were always beating numbers. Well, now we finally missed the number. We came in a little bit less. In fact, I think at 209,000, the market was expecting 225. But if you looked at the numbers, a couple really bad negatives for the market. Number one, 60,000 of the jobs of the 209 were government. So the government actually created 60,000. So if you remove that out, now you're down to 150,000 jobs, which is a pretty significant miss on the number. And to make matters even worse, the hourly earnings actually, I believe, went up. Correct me if I'm wrong, but I know it wasn't a good number, but it actually upticked a little bit, which is even worse, because if you have a weakening economy, but inflation pressures are still kind of there, the Fed is not going to step aside and lower rates, and they probably will be hiking later this month in July. The dollar going down as long as inflation is low is a positive for risk assets, which is what we've experienced for the last 20 years, right? So ever since really the early 2000s, inflation was very, very minimal, 2%-ish, maybe even a lower, which is why the Fed was able to print so much money. The tricky thing is, and the reason why, by the way, is that when the dollar drops and inflation is low, then the Fed can ultimately print money, right? I mean, if the economy weakens, they can come out and save the day and print more money. It weakens the dollar by them printing. But again, inflation's not high enough to cause an issue. The issue now is that it's a weakening economy that, again, it looks to be dropping that dollar, but inflation is going to keep the Fed on the sidelines. And again, that's the big concern here, is why you can actually get a scenario where the dollar weakens significantly and risk assets still go down. And again, this even brings up potential issues of stagflation, where again, if the economy weakens and you still, let's say, have 3% inflation above what the Fed wants, you're going to be talking about stagflation. And I think it's important for everyone to understand how negative that is. So generally, in most of our lives, we've experienced, except in the 80s, right? In the early 80s, late 70s, when inflation goes up, the economy usually is doing very, very well. So people have more jobs, they're making more money. So you can afford to pay more for an Apple or for a TV or for a car. When people start losing jobs and making less money and inflation goes up, the gap gets much, much wider, and it's much harder for people to pay for those higher cost of goods. And so that's why in stagflation is like the boogeyman when it comes to economic conditions.
The US dollar, as measured by the DXY index, experienced a slight decline on Monday, extending the losses from the previous Friday. This drop followed weaker than expected non-farm payrolls data. Traders were cautious ahead of the release of the latest U.S. Consumer Price Index report, which is expected to provide insights into the Federal Reserve's monetary policy and the future trajectory of the U.S. dollar. While an inline CPI report would not discourage expectations of another interest rate hike at the July FOMC meeting, it would prevent expectations from shifting in a more hawkish direction. However, if the CPI data surprises significantly on the upside, it may lead to a more aggressive interest rate outlook and further tightening measures beyond this month. This could potentially result in a bid up and rally for the US dollar, particularly against low-yielding currencies like the Japanese yen. Although the US dollar has recently weakened against the yen, this decline may be a temporary correction rather than a reversal of the overall trend. When an asset rises rapidly and becomes overbought, it is prone to healthy pullbacks as traders unwind their long positions to secure profits. The US dollar's weakness against the yen could fade soon, with the exchange rate approaching an important support level near 140.92, which corresponds to the 23.6% Fibonacci retracement of the January 2023 to June 2023 advance. For more daily dose crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.